Well, good morning, everyone. We have a quorum, and it is 10 a.m., so we'll go ahead and call the meeting to order. Item number 2 on the agenda is to approve the minutes of the meeting of February 14th, 2019. Have a motion and a second on item 2. All in favor? Aye. All opposed? Motion carries. Item 3 is the consent docket. Have a motion and a second on item 3. All in favor? Aye. All opposed? Motion carries. Item number 4 is to ratify approvals. Have a motion and a second. I do have one question, and I've meant to ask this a couple different times. What happens that we have all these revisions?
Normally, it's like a pay plan increase that's retroactive.
Okay.
Or somebody, we project what they're going to receive. They don't have to wait for their retirement.
Okay.
So sometimes they may work over, they may work less, they may not work at all. It's just differences in pay on what we project, meaning if we can get them paid timely and what really happens, or retro pay increases.
Okay. Thank you. We've got a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Get there. Item 5 is to approve the claims docket. I have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item 6 is to approve the following applications for service retirement. We have 6 applications. I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item number 7 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize the Secretary to make changes necessary to conform on the following. I have a motion and a second on item 7. All in favor? All opposed? Motion carries. Item 8 is to ratify approval of the following: to terminate vested rights and receive a lump sum distribution of his or her employee contribution account. I have a motion and a second on item 8. All in favor? Aye. All opposed? Motion carries. Item 9 is to approve the following application of vested rights. We have 4 applications. I have a motion and a second on item 9. All in favor? Aye. All opposed? Motion carries. Item 10 is items for individual consideration. Item 10A is sending attendees to the NCPERS Conference, May 18th through 22nd, 2019, in Austin, Texas. I have a motion and a second on item 10. All in favor? All opposed? Motion carries. Item 11 is the investment consultant report. Jason, the floor is yours.
Quick. Well, I won't try to slow you down. So we just have the ASAP this morning, the monthly ASAP. As we came through last week, Friday was actually 10 years from the bottom of the market. March 9th was considered the trough in the markets where then we started to move upward. And I think as you look at 10-year numbers now, it's pretty shocking to see how good of a 10-year period we've actually had in this low yield environment. We know equities have gone up, but through Friday, the S&P was up over 17.5% annualized over a 10-year period, as was small cap U.S. stocks. So U.S. stocks really leading the way, but that's annualized year over year for a 10-year period. International and emerging markets were up in double digits, not to that degree, but about a little over 10% for international and emerging markets. As we look at your portfolio, and this is through the end of February, and I'll just turn to the second page of the ASAP. On the top, in the far right, the the total portfolio. This is gross of fees. We don't have net of fees going back 10 years, but the fund is up 10.2% annualized over the 10-year period ending February. So your target rate of return now is 7.1. Is that right? That's your hurdle rate. So this is about 300 basis points annualized over that target rate of return. I know that's not what it's been the entire 10-year period, but a very strong 10 years. That's not to say that we can extrapolate this going forward the next 10 years. The important thing to keep in mind is the starting point. We were starting from a historical low in terms of valuations 10 years ago, and we've come through this 10-year period very strong. Today, we're starting at a different point. Valuations are fairly rich. Interest rates are still pretty low. So going forward, expectations are certainly more muted, mid-single-digit returns over the next 5 to 10-year period. As you go down the 10-year column on this page, really your large cap up almost 17% over that 10-year period. Small cap up close to 18% annualized over this 10-year period, and that's mostly been your current managers, Times Square and Earnest over that 10-year period. Long short equity, it's designed to be defensive. So the return relative to the global equities, major headwind. There's a lot of insurance built in there. One of the reasons why we moved toward the K2 Mauna Kea platform was to not abandon the protection that long short equity gives, but perhaps provide a little bit less concentration and a little bit higher beta or sensitivity to the equity markets, because historically these long short equity fund of funds have provided great downside protection, but the upside capture is a little bit weak. It's early, and I know I mentioned this last month, but as we look at just year-to-date numbers for long short, up about 8.2%. Really, it's up 9.3%. That 8.2 in the composite includes the cash holdback, so that's bringing that down a little bit. But the K2 Mauna Kea platform on a year-to-date basis is up 9.3% relative to the ACWI, up 10.8%. It's a very short period of time, but that's what we'd like to see, about 60, 70% up capture instead of the 30 to 40, and a little bit higher beta. You've got plenty of volatility protection still built in your portfolio. Private equity, you don't have a 10-year number, but if we look at that and the point in time when you started investing in private equity, April of 2009, really right when the market started to turn around, that was a very good time to start putting money to work in private markets. Generally speaking, it's best to put money to work after a recession because you're buying in at low prices, and you've gotten very good returns from your overall private equity portfolio since inception, since that April of 2009. If you go out to the far right, that 12% annualized, and that's net of fees, that return, that's net of everything. Over the last 5 years, 14%. International markets, 10 years, up 9.3%, a little bit behind the EFI benchmark. Been some few challenges there, and you've made some changes to managers, but more recently, relative performance has been strong. 3 years, up almost 11%, up about 100 basis points over the benchmark. Emerging markets, again, you don't have a 10-year history there. You got into emerging markets in 2012. It's been pretty volatile, and that's why you have only a 5% target to emerging markets, but over time, designed to be a return enhancer, but we recognize that there's a lot of volatility with emerging markets. Oftentimes, when we look at the quilt chart of best performing and worst performing asset classes, oftentimes emerging markets goes from the top to the bottom, back to the top, 1 year after the next. And that's a reminder as to why it's important to rebalance. We take from what's done well and we put it in what's not done so well, or we we add to what's not done so well in anticipation of it going up. We've done a good job of maintaining and sticking to your discipline of that asset allocation. Fixed income overall, a 10-year period where we know yields have been very low, near zero yields in cash, and 10-year Treasury getting down in the 1.5% range, which is a pretty good indicator of where returns are going to be for bonds over that trailing period. Your bonds overall, when we roll them all up, over the 10-year period, up a little over 5.25%. So you've done some things there. We've really changed, this just for as a reminder to board members that have been here and to new board members. If we went back and looked at the fixed income implementation prior to 2008, not just for your portfolio, but for most institutional investors, many had much more passive exposure to bonds, just getting the exposure of the market, because we were coming through a 20-year bull market in bonds where interest rates were going down, and you're simply riding the wave as rates come down, valuations go up. But beginning in 2008, the opportunity to add value through sector rotation and security selection, through seeking out higher relative yield in a very low yield environment, and to potentially, we've talked about this ad nauseum over the last 10 years, and it really hasn't come to fruition until recently, protect against rising rates. You've done things in your bond portfolio, Western, which is a lot more high yield, floating rate debt, emerging market debt, non-U.S. debt, the PAMCO strategy, which is an absolute return hedge fund strategy, not looking like bonds, and then Brandywine, primarily non-U.S. debt, all designed to mitigate against low to rising rates, and you've really benefited from that over the 10-year period. In the 1-year period, you can see really trailing the aggregate benchmark by 2.5%. Most of that was the fourth quarter, as we saw yields come down dramatically in the fourth quarter. And what we've done in your fixed income portfolio is really try to take out that interest rate sensitivity, so not benefiting when the 10-year went from 320 down to 260 in the fourth quarter as a flight to quality. Rebounded a bit year to date overall. And then real assets, and this one's somewhat interesting, looking at that 10-year number, because your real estate portfolio, primarily Morgan Stanley, and some of the private real estate has done very well. But the 10-year number, 4.7%, so relative to stocks and bonds, a little bit lower over the 10 years. Relative to the custom index, you've added about 100 basis points, a little more than that. What's important to recall, real estate valuations lag. So 2008, and the great financial crisis was really fueled by high leverage in real estate and real estate related securities. But the private real estate market really, in terms of returns, wasn't down in 2008 like equities. It was 2009 because of the valuation lag in the private market. So the impact of the great financial crisis is still seen in these 10-year numbers for your private real estate in terms of absolute returns. But overall, portfolio, and just really wanting to emphasize that 10-year return of 10.2%, very strong relative to your hurdle rates. Going forward, year-to-date numbers have been very good. If you look at just the month of February, the portfolio is up 2.3%. The first 2 months of the year, you're up almost 8% after somewhat of a big downturn in the fourth quarter of last year. So at the end of February, the total fund stood at $730 million. I think we're down under $700 million at the end of the year. So a pretty big bounce back over the first 2 months. No manager issues at this time or concerns. We planned last month we had your 2 small cap managers in for an update. We plan to bring in managers every few months just for updates. We haven't done that in a while. We spent a lot of time last year on the hedge fund portfolio. Next month, we have teed up Brandywine and Western Asset Management on the fixed income side to come in and provide you an update. So with that, any questions?
Thank you, sir.
Thank you.
Item number 12 on the agenda is comments from board, staff, and citizens. If you plan on going to the NCEPers, please be prompt about letting Renee know so she can make the arrangements. And item number 13 is adjournment at 10:16. Thank you all.